We are transitioning from a one-dimensional market into a multi-asset reality. Investors want exposure to the transformative tech and AI momentum, but they're also looking to exploit the massive valuation discounts overseas. Underneath it all, investors also wanting to anchor their portfolios with high-quality income now that higher rates are here to stay. It is no longer about growth versus income. Today's landscape gives you the tools to capture both. And here to elaborate is Lance McGray, Managing Director, Head of ETF Product at Advisors Asset Management. Lance, thank you so much for joining us. It's great to have you.
Stephanie, it's always great being with you. Thank you again.
Okay, let's start with AI and semiconductor stocks. They have been among the market's biggest leaders. How has that momentum influenced TRFM's portfolio, and what role have those trends played in overall performance?
Yeah, this is a great question and one that we get often here at AAM. And before we get into the specific impacts of these stocks on the AAM Transformers ETF, I think it's important that we take a step back and we actually highlight what's actually unfolding in the world of AI, and more specifically, AI spend. There's no doubt, there's no denying that, I should say, that the age of AI is here and it is transformational. You know, we're all talking about the Mag 7 and chip stocks, but what is starting to happen is that the beneficiaries of the AI investment now go way beyond chips. So if you think about it, the AI spend for 2026 is nearly $850 billion. That's this year alone. That's 35% higher than the estimates at the beginning of the year. And that figure is projected to reach nearly 1.2 trillion by 2028. That's massive. That's huge. That's nearly 3% of GDP. So really the question becomes that we're trying to help advisors and investors ask is, where is all of this money going? And it's not just chips. Think about the construction around data centers, energy spend, defense, cybersecurity, and the list goes on and on and on. The opportunity around AI has the potential to be one of the largest global investment themes of our time. And we think we have a great solution that would be the AAM Transformers ETF, ticker TRFM, to capitalize on this. If we look at what TRFM, for your viewers who may not be familiar with the ETF, it's a rules-based ETF whose underlying index is really structurally designed with screens emphasizing R&D as well as sales and CapEx growth. Now, the goal with this strategy and the underlying index is to capture disruptive technology trends. And you may say, well, that's not an AI specific ETF, and you are absolutely correct. But the underlying index methodology is naturally pulling in a lot of AI and semiconductor adjacent businesses, such as advanced micro devices, NVIDIA, Micron, Lam Research, Seagate, and many, many others. Importantly, though, TRFM's benefit from AI doesn't exclusively come from chip exposure. TRFM, because of the underlying index methodology, it's positioned extremely well across the broader AI infrastructure stack. So we're talking electrical equipment, we're talking power management, industrial automation, networking, and software. And that diversification has really been very, very important to capitalize on this trade. As a result, I'm happy to report that TRFM is a 5-star rated ETF by Morningstar. It's currently beating nearly 95% of its peers in the global large stock growth category over the last 3 years. So the performance has been fantastic. And really, not only does Transformers provide exposure to the next big thing, but it also helps address many of the major concerns that growth investors are experiencing in this environment, specifically when it comes to concentration, and more specifically, concentration to Mag 7 exposure. The performance of TRFM has been fantastic, as I mentioned, but what makes it even more appealing is that it's done it with over 260 holdings, and its Mag 7 exposure is less than 5%. So when you talk about a growth product that's certainly well diversified, and I should also mention the largest holding is only 159 basis points as of this morning. Lastly, when we talk about transformers, we talk about access. We talk about what it provides investors that it's not getting elsewhere. And the fact of the matter is, when you are looking for potentially the next Mag 7, it makes sense that you have to look beyond the broad-based indices that many folks follow, whether it be the S&P 500 or the NASDAQ 100. And that's exactly what Transformers does. We say it all the time. We may not know what the next NVIDIA is. We may not know what these stocks are going to be comprised of, or the Mag 7, which stocks are going to drive the market forward. But we can almost, I don't want to say assure you, but we feel very confident that it's going to find its way into the Transformer strategy. Lastly, on the access front, I'm happy to report that if you think about, or if you look at the Transformers holdings, there are 48 holdings that are not found in the NASDAQ 100 index that have a greater than a 50% return on a year-to-date basis. And if you go back over the last year, there's over 102 holdings in the Transformers portfolio that are not in the NASDAQ 100 that are up over 50% year-to-date. So again, we think Transformers is a very interesting ETF to allow investors to capitalize on the growth and the trajectory of the AI trade going forward.
U.S. stocks have dominated for many years now, but valuation gaps between the U.S. and international markets remain wide. Is now the moment that investors should revisit global diversification through strategies?
We absolutely think it is. Many investors are beginning to revisit the international diversification precisely because of the valuation gap between the U.S. and non-U.S. equities. It remains historically wide, and for that reason, it's very attractive. Now, I do want to be very clear that our call is not the case that U.S. stocks are quote unquote bad, but that international equities still trade meaningfully discounts, which obviously, when you're looking about portfolio construction, the potential for risk-reward trade-off for a diversified portfolio could be very, very beneficial looking at international equities. That is very hard to do for many investors. For the better part of the last decade, U.S. equities have outperformed international markets, mainly because of dominant mega cap technology leadership, stronger earnings growth, superior profitability, and a stronger dollar. But that performance, that relative outperformance, I should say, has also sort of pushed U.S. valuations materially higher relative to the international equity market. And quite honestly, when you're looking at the developed or international emerging markets areas, there's substantial discounts to the U.S. equities, whether you're looking on a price to earnings, price to book, or even dividend yield metrics. And we think here at AAM, that backdrop creates a very strong case for investors to be selective in their international exposure through active strategies, such as the ETF that you mentioned, the AAM TOD International Intrinsic Value ETF, ticker TIIV, which focuses on intrinsic value and quality-oriented global businesses rather than, broad-based mega cap weighted international indices. When we think about TIIV, it's always important to talk about the active versus passive nature and the challenges that have come with some of the more traditional international ETFs. And those would be overweight, slower growth economies, allocation to heavily to state-owned banks and financials, and even the lack of exposure to high-quality compounders. And that's really where the team at TOD strives. Their unique intrinsic value approach really attempts to solve for that by blending the best of traditional stock disciplines, right? We're thinking about valuation discipline, we're talking about fundamental discipline, and market recognition. And that certainly matters in this environment where we are seeing a number of, emerging tailwinds that may potentially help international equities going forward. So we're talking about a weaker, stabilizing U.S. dollar, improving fiscal stimulus abroad, manufacturing and defense spending, specifically in Europe, or corporate governance in places like Japan. So, as it pertains to TIIV and Todd's positioning at the moment, these are some of the areas that they're looking at. They're looking at Japan, they're looking at Europe, because there's a lot of areas of the market that are still trading at sizable discounts, which we think are very, very attractive. So again, to summarize, we're not making the argument that, global diversification today is less about calling the top of U.S. equities, but more about improving the portfolio balance and expanding the opportunity set when we're starting to look at, a well-balanced ETF portfolio allocation that's diversified both domestically and internationally as well. So we're super excited about having Todd on board. Again, the product has been in the market not for too long. It's been in the market for, I believe, less than a year. But it's important to viewers to understand that Todd has over a 20-year track record in investing in international stocks. And in fact, the same strategy that TIIV is built on has been live in other wrappers since 2005 and has provided about 79 basis points per annum of outperformance on a net basis going all the way back to 2005. So TIIV is certainly a product that we think should stack up well when investors are looking for international equity active exposure.
And for more than a decade, investors were forced into riskier assets chasing yield. But now with higher rates, investors have choices again. So Lance, where does the role of income ETFs like PFLD fit into the current landscape?
Yeah, you're absolutely correct. And for much of the post 2008 era, investors have really been faced with difficult trade-off, right? Do we want to stay conservative and earn almost nothing in cash or bonds, or do we want to move further out on the risk spectrum into equities or longer durated bonds or lower quality credit in search for that yield that, quite honestly, some investors need? In today's higher rate environment, that has changed the equation for income-seeking investors. And created a lot of opportunity. In the current environment, if inflation remains sticky, which we believe it will, it's likely that the Fed is going to keep rates, relatively higher for longer, which means bond volatility may persist. Interest rates, again, for the viewers, the 10-year at 4.5% or 5%, we would argue is not abnormal. What is abnormal is the previous zero rate environment that we were in. And we just argue that we're in the process of interest rate normalization, and we are closer to being done than not once the war actually settles. So with that said, there are opportunities out there. We are looking, specifically in the 5 to 6% coupon ranges, and that's providing inflation, that's providing yield numbers well above what inflation currently is. So when we look at a real yield perspective, so that's yield after inflation, there's a lot of opportunity out there. We also recommend staying, relatively shorter to intermediate term in terms of maturity profile, again, just as a slight hedge against higher rates. But the fact of the matter is, and this is a great benefit for investors, that investors can earn the lion's share of yield offered along the yield curve and still stay relatively shorter in duration. And I think that's one thing that we focus on with PFLD is that when it comes to preferreds in today's rate environment, there's three themes. The first thing is income is attractive again. So you have PFLD that has a SEC yield of greater than 5%, very, very attractive. Duration risk still matters. So again, if you can, based off of PFLD's underlying index methodology that removes a sizable amount of duration risk and still receive a very handsome income stream, very, very important. And then lastly is the diversification, right? We're not only looking at the issuer basis, but also the structural basis of these preferred. So $25 exchange listed preferreds, as well as the $1,000 OTC preferreds as well, are all found in PFLD. So really interesting product there. It sort of is a middle ground between taking on the equity risk or taking on complete credit risk. These are hybrid securities, and we think that there is a lot of benefit, as I mentioned. Attractive levels of income, minimal duration, and obviously added portfolio diversification that you might otherwise not get from traditional bonds or equity strategies.
Yeah, that makes sense. Well, one final question before you leave us. Beyond income from traditional sources like stocks and bonds, strategies like CLOC, seek income in attractive areas that many investors miss. So why do these strategies suddenly seem much more relevant today?
For many years, again, same tune with PFLD is, many income-focused investors sort of relied on the 60-40 toolkit, right, of stocks and bonds. But today's market environment is pushing advisors and investors to think more broadly. We pair that with, well over 5,000 ETFs in the marketplace, and there are a tremendous amount of opportunities out there. One area that has been gaining increased attention over the years is the collateralized loan obligation market, or CLOs. And this area of the market, historically has really been only accessed by institutional or specialized investment professionals. But the growth of ETFs, the growth of actively managed ETFs has made this asset class much more easily accessible for both institutional and retail investors. So again, we're awfully proud. CLOC, the AAM Crescent CLO ETF, is one of the newer ETFs to our lineup. We think it's a rather unique solution, but that's managed by one of the strongest managers in the CLO space, Crescent Capital, which goes back to issuing the first CLO back in 1993. So again, we're talking about an active strategy managed by a manager that knows the space extremely well. And the other differentiator for CLOC over many of the other CLOs, nearly 30 of them in the marketplace right now, is that many of those strategies, albeit active strategies, they focus on specific tranches. So it may be AAA or BBB exposure. The unique aspect of CLOC is that it allows the sub-advisor, Crescent Capital, to find relative value up and down the entire spectrum of the investment grade CLO market. So again, it provides them some flexibility in finding that relative value that, quite honestly, other ETFs might not be able to achieve. So again, you pair that with the lowest cost active CLO in the marketplace, and this is a product that we think can help advisors and investors achieve elevated levels of income, mitigating duration risk because of the floating rate nature, and also provide added diversification portfolios as well.
All right, we are going to leave it right there. Lance McGray, thank you so much for dropping by and sharing your insights with us. It's always a pleasure to see you.
Thanks for having me.
You're very welcome. And to learn more about the ETF strategies that we covered today, visit Advisors Asset Management at aamlive.com. The link is posted in the description section below. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching.